points higher. Yes, indeed. The markets roar higher last 30 minutes of trading as volatility once again rules the day. Let's talk about the speed with which we are watching this market deteriorate.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Hello and welcome. Stock prices go up and down a lot. Because of that, investing in stocks feels very risky. Emotionally, it is hard to see your investment portfolio fall by 20% or even 50% and not do anything about it. If you manage to control your emotion and not sell when stocks fall, you will do extremely well in the long term. Stocks offer by far the highest return among all the other alternatives. If there is one thing you'll take away from this video, let it be this. The biggest threat to long-term returns is your behavior in the short term. Remember that. There are 6 stock market truths you need to know to avoid making these behavioral mistakes in the short term and get into the right mindset. Investing in stocks feels very risky. It looks like gambling. This year so far, Netflix stock is down 70%. This is not the first time Netflix stock fell by 70%. In between 2000 and 2018, it lost 70% of its value twice and lost half of its value on 6 occasions, despite increasing 500-fold during that period. It feels safe just to buy a house as your parents or grandparents told you to. But over the past 150 years, stocks have generated a real return after inflation of 6.49% per annum. By comparison, housing returns are only 0.4%. Just 0.4%. Robert Shiller, whom I studied under at Yale University, worked with another professor, Carl Case, to come up with these housing return numbers. On the one hand, stock investing feels risky, but on the other, they offer the best returns by far of all the asset classes. So what do? The only way to benefit from the high stock returns is by getting into the right mindset for investing. This mindset will help you toughen up and keep going even when you see stocks and along with that your investment portfolio falling by a lot. Knowing these 6 stock market truths will go a long way to help you get into the right mindset. What happened this year so far in the stock market, which fell by about 20 to 30%, is not something unheard of. In fact, what happened in the financial crisis of 2007-8 when the stock market fell by over 50% and people thought the world was coming to an end is not unheard of either. It happened many times in history. Let's count how many times. That's a total of 52 times when the stock market fell by at least 10% in a short period of time. Very often the fall is much more than 10%, 20% or more. In the United States, there have been 18 instances over the past 150 years when stock market fell by 20%. The worst one was the crash of 1929, along with the first part of the Great Depression, which saw its 79% loss. It took the market a little more than 4 years to recover from that bottom. Every time a crash happens, it feels like the end of the world. In 1979, Business Week cover famously read The Death of Equities, which as it turned out marked the coming of the greatest bull market of all time. Market crashes have occurred regularly in history and will happen again. The Economist magazine is probably the best current affairs magazine in the world. Everyone from Bill Gates to the presidents and prime ministers around the world read it. It publishes what's called the World Ahead in January of every year, forecasting the big developments that will shape the year to come. In January 2020, it did not write a single word about COVID, the biggest event that year, which changed the lives of almost everyone in the world. In January 2022, it did not write a single word about the Russia-Ukraine war that is having and will continue to have a far-reaching impact around the world. The uncomfortable truth is that future is unpredictable. But you can be sure that in the next 10, 20, 30 and even 40 years, will have just as many collapses, recessions and disasters as in the past. Governments and central banks cannot prevent financial crisis or stock market declines. Every single time the stock market fell, it recovered and kept going up. Every single time, no exceptions. After these 18 instances of financial crisis in America, it took an average of 4.4 years for the market to recover. So from the peak to down to up again to the previous peak, it took 4.4 years on average. It took an average of 2.1 years for the stocks to hit the bottom and an average of 2.4 years to reach the previous peak from the absolute bottom. Some of these bear markets are much longer than others. For instance, the lost decade that started in 2000 lasted for 13 years. It took 9.1 years for the stocks to reach the absolute bottom in 2009. And it took 4.1 years or until 2013 for them to reach the level they were at in 2000. But such long periods of bear markets happen very rarely. If you remove the top 5 instances that lasted the longest, obviously the bigger the crash, the longer the recovery, the average time it took for the markets to fully recover is only 2.1 years. And just because you have capital losses in stocks, it does not mean you won't earn any money from these stocks. Many stocks pay dividends. For instance, during the lost decade between August 2000 and May 2013, though the S&P 500 index prices fell by about 18%, had you invested $1,000 every month during these 13 years, in other words, had you practiced dollar cost averaging, your annual returns would have been 6.65%. That's right. Even if you started investing during the longest bear market in the last 150 years, you would have a very decent return of 6.5%. If your returns are 6.65% during the bear market, what would the returns be when the market is going up? I'm including a website where you can calculate it yourself and play around if you like. Remember that stocks always recover without any exceptions. All you have to do to benefit from stock markets is to toughen up and let it ride. Take a moment and let that sink in. This is the most important point I'll be making today. Always. Probably no one told you that before, but it is true. It's important to understand it will not be a smooth ride. It's most often a wild and rocky road. In fact, the more you zoom in, the wilder the ride is going to be. So if you have the habit of opening your stock app and checking its current value multiple times a day, it will be emotionally draining. But the stock markets always, and I mean always, go up. Not each and every year, not each and every month, not each and every week, and certainly not each and every day or every hour. But take a moment and look at any chart of the stock markets in any country over time. The trend is relentlessly up through disaster after disaster. Had you invested $10 in the US stock market 150 years ago, it would now be worth $225,800 despite so many stock crashes. In other words, staying in the market and weathering the storms has paid off for investors. There is of course some survivorship bias. In hindsight, you are only looking at companies that survive. What about all those companies that went bankrupt over the past 150 years? You might think, had I invested in one of those companies that went bankrupt, my wealth would not have gone up. How do you know which companies will go bankrupt and which won't? That's a good point. But you don't have to if you invest in an index fund. My last video, which you can find somewhere here, is exactly about this. Check it out.
And sit down.
I came across this report called Long-Term Asset Return Study by Deutsche Bank that looks at historical asset class returns going back to 1800s. This study shows once again that short-term stock market returns can be highly predictable and unstable. But in the long term, returns have been far more stable. While the returns have been elevated for the past 5 and 10 years, there isn't much difference between returns over longer periods, over the past 25, 50, 75, 100 or even 200 years. You should take comfort in that. Though there are no guarantees, you can expect future returns from stock markets to be about 6 to 7% every year on average. Keeping your money in cash or investing in short-term bonds can certainly be helpful when you need to spend your capital in the near term. But if you hope to beat the rate of inflation consistently over the long term and grow your capital, you need to accept some risk in your portfolio. Keeping your money in cash or putting a deposit in a bank will always feel safer than investing in the stock market. But the stock market gives you much higher odds of increasing your standard of living, since they have a much better track record of not just beating inflation, but generating the highest return of all asset classes in the long run. So these are the returns of different asset classes by decades. As you can see, there are some decades where stocks had a negative return. You can have a positive return on a portfolio if you follow the dollar cost averaging, as we saw in the video earlier. These numbers are for the US stock market, but stocks have generated the best return by far in almost all the other stock markets around the world. If you're wondering what the returns for the housing market are, they barely beat the inflation. As you can see in this table, since the 1890s, US nominal home prices have increased by 3.2% per year and inflation was 2.8%. So the real inflation adjusted increase in US home prices since 1890s is 0.4%. That's it, only 0.4%. Having said that, housing prices have gone up a lot in the past 5 to 10 years, but they always go back to the long-term average. Periods of high returns are followed by periods of low returns. That's just how the market works. Home price growth has already started slowing down, most likely, as the interest and the mortgage rates are going down. There are a few things you can do to handle the roller coaster ride of the stock markets and ride out the storm. The first thing to know is that these bad episodes when the stock markets plunge are coming. They will happen and they will hurt. Don't let them surprise you when they happen. And unless you panic, they won't matter. Second, don't invest the money that you need in the short term, say in the next 5 years in the stock market. And you definitely should not have your emergency fund invested in stocks, because you could end up locking in losses if or when you need that money in an emergency. Depending on your balance and specific holdings, you could be seeing your portfolio value drop by 10,000, 20,000 or more from one day to the next during periods of high volatility. That's enough to drive even a seasoned investor to the point of panic. So for this reason, you should avoid checking your portfolio balance every day, especially during rocky periods like the one we are in the middle of. This also holds true for stock market news. Don't listen to daily stock market news. Remember, the biggest threat to long-term returns is your behavior in the short term. Have a well-diversified portfolio. I'll make a more detailed video on this topic, but don't try to pick winners and invest in individual stocks. Invest in a diversified index fund. No one can pick winners consistently and reliably, and individual stocks are a lot more volatile than index funds, as we saw in the case of Netflix. Index funds solve both the problems of stock investing. You don't have to pick winners, and your portfolio will be a lot less volatile. My last video is about this. Check it out. Because stock markets feel risky and the emotional roller coaster ride you experience, people either stay away from stock markets or panic and sell stocks after the markets fall, locking in the losses. Don't do either of those things. If you really want to be the master of the game, buy when stocks collapse and everyone is scared.
If you have a temperament that when others are fearful, you're going to get scared yourself. You know, you are not going to make a lot of money in securities over time in all probability.
It's the hardest thing to do, but if you can do it, you'll be on the faster lane to riches. This is what Jeff Bezos said about Amazon during the dot-com crash.
The stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way.
He and Warren Buffett are exactly on the same page about the underlying economics of the business. What wonderful buying opportunities there'll be during a time like now. S&P 500 is down 20% year to date. The economics and the prospects of the underlying business in this index are pretty much the same as they were 6 months ago. But the maniac depressive Mr. Market is valuing them as 20% less. It's like a huge sale. Remember that the biggest hurdle to your long-term returns is your short-term behavior. The only way to benefit from stock markets in the long run is to toughen up and ride out the storm. This is Sharath Mantravadi. Thanks for watching.